Dan Tapiero, you're back. How are you, my friend?
Raoul Pal. I'm good. I'm good. I mean, great to see you. I know we've been trying to do this for a little while, and sorry it's taken some time. Great to be back and chatting, and was really hoping we do this in person. I feel like we have such a good rapport in person, but look, this is good for now.
We will get back there, but we're currently on two different Caribbean islands right now, so it's not the end of the world. Dan, let's update people with what you've been up to, because as ever, I love the way you approach things. You find a macro thesis, then you look at a way of playing out a macro thesis in a kind of non-traditional way. And you've done this your whole career. So let's just give a bit of backdrop of some of the times you've done this before. We don't have to go into too much detail, but I'd love to hear what you're doing now and why you did it. And then we'll dig into all sorts of stuff.
Yeah, I mean, it's very funny. Again, as you know, was a portfolio manager in the hedge fund world for 20 plus years. And of course, at all those names at Tiger, at Duquesne, SAC, et cetera, worked with some of the great guys. And I had the advantage of really seeing how each of them looked at markets, how each of them processed information, made trades, structured their portfolio. And I think that sort of gave me a very unique view. Also throw Michael Steinhardt in there in the early days. So, and I didn't really have a traditional way of approaching or looking at markets. Again, it was it came from a combination of experiences. And so that was on the portfolio management side, but I also had a natural bias towards thinking more long-term. And of course, would see that, if you sat with some of these macro ideas, macro views, and you didn't trade, or you weren't forced for some reason to trade the mark for the month or whatever it is, that the returns could be astronomical. And so in '06, when I was working with Druck and focused on grains, mostly on grades in agriculture at that time, I'd written up the sort of typical 50-page investment memo that my team and I actually still do, lots of in-depth work on this idea that U.S. farmland prices could double in the coming 5 years. And we had all our different reasons for expecting, that to happen. And again, the original, the memo was for the purposes of explaining the position in futures and swaps. And I remember Stan just coming in and saying that, he loved the idea. Was there another way for us to express that bet? And again, out came this investment memo about the doubling of price in grains, but also doubling of price in the farmland in specific locations. It was mostly in the Mississippi Delta, Nebraska, Illinois. I came up with this sort of 20-item checklist. We hired a CEO. We partnered with the Goldman Sachs partners, and we built AGCOA from the ground up. And by 2013, it was the largest private farmland REIT in the U.S., and we ended up selling it to the Canadian Pension Fund System, CPP, for $450 million. So it was an aggregating business in a sense. It was a macro view that I'd come up with that was expressed in a different way, in a unique way. What shocked me, there are a lot of interesting things. Shocked me really was only at the time there were only 4 other sort of institutional buyers of U.S. farmland at the time. And I don't think it's really increased that much. And the total market value, and I can't recall exactly, but the total market value of U.S. farmland was in the hundreds of billions. And so, high hundreds. And I just thought, how could there only be a handful of institutional buyers? And the answer is because it's hard to do. You have to hire a team. You got to kick the dirt. You got to get out and see if, everything pencils, as the farmers say. But that was sort of my first introduction. I really, give Stan a lot of credit for sort of pushing me in that direction because, he has long-term views, but he also has, shorter-term views and likes to trade, et cetera. But he really sort of backed my idea and was very supportive. And again, we were partners in that business for 7 years, a long time, a lot of weekly and biweekly meetings talking about the different farms, et cetera. I give him a lot of credit for, helping me sort of adapt in a way and learn and adapt and learn how to sort of maximize, P&L on a macro idea with a dramatically different risk reward perspective, risk reward structure. I mean, how dramatic? I'll tell you, in 2008, our portfolio of farms actually marked up. It was bonds and our portfolio that were the only assets that were up over 2008. And so that made me see something really important, which is that I could get access to something that was extremely volatile, the underlying grain futures, and I could hold through a very volatile period.
Yeah, just to explain, I, on the other hand, had the same thesis, set up a hedge fund with a friend of mine, and had to close it down in 2008 because of the volatility of trading the underlying as opposed to the actual farmland. So you had a much superior bet.
Yeah, well, yes, in a way. And again, we ended up doing well with the farms. Many of them doubled and tripled in price. And I don't know that necessarily in every type of bet like that you're going to, outperform the underlying. I don't really know. I mean, and again, I didn't really care. What I cared was I wanted to get exposure. I didn't want to get liquidated at the bottom by some panicky, investor in, Switzerland or whatever it is. And I wanted, and we didn't have that many outside investors, but I really wanted to hold the bet. And again, if you looked at what the relative, Sharpe was, I mean, it's probably, massive difference. I mean, I never looked at it. I didn't really care so much, but the fact that it never marked down through '08 was just, incredible to me, right? And then, of course, what happened was we started buying again in early '09, right? We paused a little bit in '08 just to see what was, to make sure that the whole world hadn't completely blown up. And then I'll never forget this. There was an auction in early '09 in the Midwest, and it was a big farm, and they chopped it up into 50 different pieces. And there were literal bidding wars breaking out for these plots of this one auction. And I remember, sending Stan an email saying, listen, I know liquidity is tight in the traditional world and things have blown up. And it was like February, March '09. But I'm just telling you, there are panic bidding wars breaking out on pieces of land. We should get back into gear, right? And we did. And so again, starting a business from zero, you also, you have many more different ways to win. It's not just a straight binary bet on whether the thing flashing on your screen goes up or down. It's a productive asset. It yields something. It's true collateral in a sense. Farmland, it's not disappearing. So again, if you have the ability to hold something and you believe in it long term, you have to have it in a structure that allows you to do that. And so in a way, I did sort of the same thing again with GBI, Gold Bullion International, my gold business, very bullish on gold and physical gold coming out of '08, '09. And I wanted to start, an operating business that would give me leverage to the, growth in the gold price over the coming 5 to 10 years. Because I thought after '08, '09, rates are going to be zero or real rates for a long time. And gold will benefit in some way. But gold is very difficult to trade. And I've been trading it since the '90s. I know you have too. And it's just the kind of thing that it never does what you want it to do.
Never.
When you want it to do it. And silver is 10 times worse. And I thought, you know what? I'm gonna die early, trying to figure out when gold is gonna have its, 20, 30% year or whatever it is. Let's just set up an operating business. I want to own physical. I want to own it outside the banking system. I brought in a co-founder of mine who worked with me on the ag, Raoul, who an ex-Goldman Sachs partner. And he and I co-founded, this company, and he's still the CEO today, 11 years later. We just had a record year last year. I think we're going to have a record year this year. And again, it's sort of starting an operating business from zero also, allows you to pay the long-term capital gains tax instead of, the income tax from trading and short-term gains.
Also, the other thing that you managed to do in these structures is they become positively funding vehicles to express your macro view. Now, it requires work because you have to set up a business, so they're not easy to do. But once you do it and you get it right, they positively fund and then give you the exposure you want.
Yeah, no, that's exactly right. And, there is sort of a moat around it because it's kind of a pain. I never forget in the gold business, we had this idea, like, how do we become the blue chip provider of physical gold, like to the world and especially to sort of the wealth management world? And we had this almost silly idea in the time, but we thought, okay, let's get on the Merrill Lynch wealth management platform. There are $3 trillion in assets at the time, 16,000 FAs. We'll just plug into their distribution network, no problem. Anyway, we had to build a technology, build the platform. It took 18 months of due diligence. And I've said before, proctological examinations from Merrill Lynch. And we went through, nearly failed many times. We had a great team at the time that really made it happen. It was difficult and we could have failed. And it might not have been, in the first several years even of that business, we were break even, and even in the beginning, losing bits of money. So it's not easy, but we had a long-term vision. We did get on that platform. We became the first new company ever to get onto the Merrill platform. So that was exciting. And all of a sudden now anyone in that world, and if you have an FA at Merrill and you want a physical bar and you want it stored in Singapore, that FA just pushes a button on a screen, and then that's us. We integrated with them, and we call it the Merrill Lynch Precious Metals platform, but it's us, and we partnered with Merrill, and we now have, I'd say, 10 to 15 business verticals like that. And so even when gold goes down, okay, and this is the great thing, we're still making money. And even when gold goes sideways, we're still making money. So because we have different business lines that do different things, it's sort of interesting. I don't want to get too much into this, but it's sort of interesting. We have business lines where the community of that vertical, let's call it, only buys, or let's say likes to buy when the market's going down. We then have other verticals where that community likes to buy only when the price is going up. So, it's just worked out that way. I can't say that, we did it purposely, but it worked out that way. And so you've got a business that is just always running. And as you said, now, is throwing off dividends every quarter and is sitting with a big cash balance and, wonderful EBITDA numbers, et cetera, et cetera. So again, that's 15 years of sort of experience expressing a macro idea through a business, through a different structure that is unique. And again, I guess that leads us to 10T, which is, what I'm doing now.
What I love about 10T is we've followed your whole journey from you tapping me on the shoulder saying, listen, I've been doing the work. You've got to start looking at this again. And then your whole journey of then setting this whole thing up. So explain to people what you're doing and your idea behind that. And then we'll dig into the portfolio and stuff a bit as well.
Yeah, I mean, look, many people, I still get like once a week at least or more, I don't know, people saying, that interview you did with Raoul in the summer of 19, that got me to take it seriously and this and that. And I'll tell you, I was so happy about that. It was sort of, we had been talking for months, of course, about the idea. And I just came on and, we just talked through what we'd already been talking about. And so that was sort of my initial big foray into the Bitcoin. And again, the 80-20, or it was, I think, probably 85-15 Bitcoin Ethereum exposure I did at that time, which of course now is skewed much greater towards Ethereum, as you mentioned before. But, I did all the work, fell down the rabbit hole big time in sort of 18, early 19, and then had the position on. And just like with Agcoa, sitting with the grain position, I started to think, okay, I'm bullish on this space for the next 5 to 10 years at least. How do I get an exposure where I don't have to sit through 80% drawdowns, where, we know that that's what's happened. Bitcoin has had 7 drawdowns of 80%. Ethereum went down 95%. It's not pleasant. And I'm going to have my position. You know, I'm a hodler there, and I'm not going to touch it. I'm not going to think about it. But the space is growing, and there's so many interesting genius type intellectual guys also under the age of 35. I think this is the future. How do I participate in it?